Hello, this is a debrief of the SBR exam which was published by the ACCA for September and December 2020. Before you listen to the debrief, first of all you need to download the exam from the ACCA website, and I would suggest very strongly that before you listen to the debrief of each question, that you read it carefully and do your own answer, or at least a plan of an answer, so that you know what I'm talking about. At this stage, I would strongly suggest that you don't read the ACCA answer. That's like trying to climb a mountain before you can climb a hill. So look at the question, spend some time on it, do a plan, and then listen to my suggestions. As always, I'm not aiming to get people 100% in the exam. I've worked on this exam for a very long time, and I don't know anyone that's ever got 100%. So if you think you're that person, I'm just saying I don't think so. My concern is to make sure that you pass, and hopefully pass comfortably. And to do that, I'm going to be pointing out how to get the easy marks. So first of all, download the exam and work question 1, pause the recording, and then when you're ready to go, follow on and listen to the next part of the recording. Question 1, which as always is a question that has some groups within it. So this is question 1. I'm calling that sugar because that's what they've called it. So question 1 has an element of group accounts in it, quite a lot actually this time. And the first requirement was worth 10 marks. And when you read the first requirement carefully, hopefully you noticed it was 4 separate questions. This was about a company that they bought. The first question was about the initial 40% investment. The second question was what happened when that investment went up to 70%. So they bought an extra 30. Excuse me. The third question was about something associated with the calculation of goodwill, and finally a brief requirement about how things would be in the cash flow. So you're almost saying it's like 3 3-mark questions and a 1 mark. The main thing is, of course, is that you cannot hang about. So the first requirement was explaining what would be happening in respect of the company's first 40%. So this was associated with the original 40% investment. And because the scenario used the word significant influence, that of course is actually associated with the word associate, which in turn is associated with the word equity accounting. So up until the date of change, when they buy the extra 30%, this will be equity accounted as an associate. So we can just make a note there to say initially equity accounted as an associate. Remember on the exam, the marks are for explaining. So if you do the calculations a bit wrong, it doesn't matter. If you don't do any explanations, you won't pass. End of story. So it's the explanations. It is an associate because they refer to us having significant influence. And the change takes place, doesn't it, on the 1st of July 07, because that's when they buy the extra shares. So let's have a look at what happens just before they buy those extra shares on the 1st of July X7. So first of all, what's happening in terms of the equity accounting? As always with anything, type out the formula first and then try and fill in the numbers. Equity accounting, remember, what do you have to remember? That normally equity accounting is cost plus share of post-acquisition profits. I'm just doing a little pi sign for profits, if that's okay. Decide what sensible units of measurement might be. You could use million, probably it's a bit easier to use $1,000 on this. So in $1,000, the cost was 10,000. It was a 40% associate. They don't tell you about the change in profit, but they do tell you about the change in net assets. And as you know, the thing that makes net assets change is profits. Profits make net assets go up. Losses make net assets go down. The change in net assets was 12 million. 4 12s are 48, so that's 4,800. On that date, that would have been the carrying amount of the associate, again, in the books. Then, of course, the 40% becomes 70. And when you've been working through the learning materials, you've seen that when 40 goes to 70, you cross the control threshold, you say goodbye to the old associate and hello to the subsidiary. So that means that the associate is disappearing. So I call it, or tend to call it, a disposal of an associate. Some people say revaluation of associate. But either way, so I'm putting it in commas, you don't need to. I'm just saying the associate is going to leave us and be replaced by a subsidiary. There's no such thing as proceeds, because what you're doing is just bringing in the new subsidiary instead. But what you have to do, remember, is to revalue the associate to fair value on that date. So the proceeds, or so-called proceeds, not proper cash at that stage, but the proceeds are the fair value of those shares. How many shares are there? 4 million. What's the fair value? That's given on the question. It's $3.80. 4 million times 380 would be 15,200. You might be saying, where did I get the 4 million? Well, it's a little bit cunning, but if you look further up the scenario, it tells you that 3 million is 30% of the company. Therefore, of course, 4 million is 40%. So there's the proceeds, 15.2, less the carrying amount, which we've just worked out. That was 14.8. There we are. That means there's going to be a profit when we say goodbye to the associate. The key thing in this exam is calculating certain numbers and telling directors where to stick them. In particular, with gain or profit items, whether they should be in the P&L or they should be, again, in the OCI. But this goes to profit and loss. So I've explained what happens with the 40% investment. I now need to explain what's going to happen with the additional 30% investment. See, there's a lot to do here, isn't there, for 10 marks? So you don't want to get carried away. But when you're explaining something like this, again, some people call it a step acquisition. If you use those words, do you get any marks? No, so I wouldn't bother. Would you get some marks for quoting the standard number, IFRS 3? No, so don't bother with that. But the message is, isn't it, that you've now actually crossed the control threshold. That therefore means, isn't it, that the company is a subsidiary. Associates will be equity accounted, but subsidiaries will be consolidated. So it will need to be consolidated. And of course, the key point now is that we would have to calculate goodwill. And the key thing about the calculation of goodwill is this word, isn't it? Using fair values of everything at the date control is achieved. It doesn't matter whatever it is. If it moves, measure it at fair value. That's the message, isn't it? What else is happening in the financial statements? Well, you could mention the NCI if you wanted to. That would be good. It's all down to timing, isn't it? But I think one of the other key things to perhaps mention is that because of the issue of the shares in return for the subsidiary, that the equity section of the group balance sheet will increase. So equity increases. Again, why is that? Because of the share issue. You might calculate the number there, or you might do it again just a bit further down when you come to look at the goodwill. Now, in every other question, they've asked us to calculate goodwill. This time, they haven't asked us to calculate it. They've told us what it is and asked us to calculate one of the components of getting to the goodwill number. Well, whatever they say we do, they're in charge, aren't they? And we're just helpless. So we'll just have to do what we're told. So we're going to have to set up a goodwill calculation. Even though it's very strange that we're going for an unusual balancing figure. In the goodwill calculation, first of all, of course, you've got to think about what we were giving. So this is the consideration. We are partly paying cash, which we don't know. That's going to drop out as a balancing figure. We are partly paying in shares. Then just follow what it says in the scenario. So we're acquiring 30%. In other words, 3 million shares. We're giving one of ours for two of theirs. And the fair value of our shares is $6. So that would give us, wouldn't it, 9,900,000. We are also, that's what we're paying for the 30%. We've also got the original 40%. That was the associate that was originally there. And the associate value originally again, here it was back upstairs here. The fair value of that associate was, let me just find my right pen. The fair value of that associate there was 15.2. So there we are. I can bring the 15.2 in now. That's the consideration. Then we've got the NCI. like everything else, measured at fair value. So the NCI was 3 million shares of the subsidiary. We've got 70, they've got 30. Fair value of the sub shares is $3.80. So that would be 11,400 less the net assets. Remember what those net assets are? There's a list of them on the scenario, isn't there? But when you add up those net assets on the scenario, the number is obviously given to you. The net assets, the total of the net assets on the scenario, on the first page of the question, is 35,741. That's the carrying amount. There's a fair value adjustment, and the fair value adjustment relates to land, and it's 600. There's no need to indent as I have, but I've just done it there to make it easier for you to see. That's 36,341. We're also told that the value for Goodwill is 2259. So we're having to balance back, and I think when you balance back again, the final figure for the Goodwill, the cash paid for the shares drops out as 3 million. So that's the answer. It drives you mad, doesn't it, when you look at these questions and the answer is a round number and yours is a strange number to 17 decimal places. It just happens, doesn't it? Remember, if that was worth 3 marks and you've made one mistake, you'll probably still get 3 marks. So they're looking at approach. If you've made 2 mistakes, I'm sure you're down to 2 marks, but you can make mistakes in calculations, but you cannot make mistakes by missing out explanations. The final requirement was then to explain what happens with a subsidiary in the cash flow statement. That's a nice basic piece of knowledge, and that is that investing activities will have an outflow, and that will be the purchase of the subsidiary. And that outflow will be the difference between the cash that is paid. They just wanted an explanation, I think. Cash paid less, which was the whatever figure we came up with just now, less any cash balance acquired. The cash balance acquired was in the list of balances of the subsidiary when they gave us the net assets of the subsidiary. If so far you've only worked part A, again pause the tape, have a look at B before you listen to the next part. Part B, well, we never like a question that says 16 marks because that sounds a lot, doesn't it? Some of you would cheer up because it says there are no explanations needed, and then immediately go into depression because it asks for a cash flow statement. Just 2 sections, and let's be absolutely clear here. Cash flow is coming up a lot in this syllabus. It's just bound to, because the exam lends itself to it. So it's no good gambling and saying, well, it might not come up for me. The next point is that you cannot create cash flow just like that. You need to know the pro forma. So back in our course notes in one of the early chapters, you've got the pro forma P&L, pro forma OCI, pro forma balance sheet. People seem to learn those. Pro forma cash flow, it's as if you say, well, that looks a bit dull. So it may or may not be dull, but you need to more or less know the pro forma. You've got to know what goes where. So you can imagine you're sitting there in the exam and you say, well, what do I do now? If you just read through the rest of the scenario and start setting up random workings, I think you're not going to get anywhere. You need to get some kind of pro forma down and then see if you can start to fill it in, and obviously more things will add into your pro forma. So I'm going to start by doing that. So first of all, I'm worrying about my investing activities. So when I became familiar with the pro forma, a long time ago I guess, I knew that investing activities include things like purchase and sale of subsidiary. I've already seen a purchase of subsidiary, and it would be very unlucky if we got a sale as well. So I'll put purchase of subsidiary. Hopefully we'll see one of those because we've already seen it. That's an outflow. I wouldn't be typing the brackets at this stage, I think, but it's just so I don't forget later. Again, there might be a purchase or sale of associate, which could generate an outflow or inflow. So you could just, even if you just put purchase of associate, you can always change it later if it turns out to be a sale, or put an extra line in. The other things you always see, aren't there, is property, plant and equipment and intangibles. So I don't know yet if there's going to be purchase or sale of PPE. So I might just gamble and put purchase of PPE, sale of PPE, that's an inflow. And the other one that always there, intangibles, I'm just going to put purchase of intangibles. Just in case. The other thing is that in group accounts, remember, you're going to have this extra cash flow, which is the dividend from the associate. So that's bound to be in there, and that's an inflow. There may well be other headings. That's fine, we can leave some space, insert some lines again, but we'll worry about that later. Now pro forma up the financing. Financing, remember, is straightforward things. It's about the issue of shares. I don't think you would ever see a redemption of shares. You might see a loan issue or a loan repayment. So I'll put it in, loan issue. That would be an inflow. There's usually a dividend paid. And again, there's usually a dividend to NCI. If I don't need some of the headings later, but how long is it going to take you to learn those and bang out those lines? Half a minute, if you learn them, that is. And then you can fill them in as you get to them. So the examiner is on your side, although people don't believe it. On the second page of the question, you can see they've listed the opening and closing assets and liabilities like PPE. On the first page, they've summarised the movements. So I would work down the movements as they're printed. They will not be dirty. So something, when you see a particular line like intangibles, it's not going to change later in the question. It may have changed earlier, but it's not going to change later. So if you can imagine always you've kind of got a mental ruler across the page as you start to work down the notes about the cash flow. So under the subheading on the question that you can see, towards the bottom of the first page, it says acquisitions and disposals of assets. The first line says, well, we purchased the subsidiary flour. Well, that's an easy one to do, isn't it? So I'll fill that in straight away. We've got the data for that already. We know, don't we, that the cash cost of the subsidiary was the 3 million. I'm just highlighting that now in blue. You would deduct the cash balance acquired. The cash balance acquired was listed in the list of assets. The cash balance acquired was 1234. By the way, if I put a transposition error in, don't worry about it, it's fine. 1766, but I think we're okay. So I've dealt with that paragraph. I'm looking back at the question now, as you should be. I'm looking at the second paragraph. It's about intangibles. A lot's been going on with intangibles, so I'm going to need to do some kind of reconciliation. It says there was no disposal, there was no impairment, but there's been some amortization. What's missing? The additions. They've not mentioned additions, so there must have been additions. So now's the time to think about a working. Don't set up all the workings straight away. Only set up a working when you need it. Then hoover your way round the question, just trying to find the data. So I've got the opening and closing balance on intangibles. You'll probably need to keep pausing the tape in this section. But the opening and closing balance, which I think were 15,865. And 33,456. I've got the intangibles that came in with the new subsidiary. That's in the list of the assets taken over. And that's 6,781. When the subsidiary arrived, we also calculated goodwill, and that is something that would increase the opening intangible to make it the closing. So there's also the goodwill, which we were given before, weren't we, which was 2259. We're told the amortization, which was 3,500. Now you get the additions out as the balancing figure, and the additions drop out as a balancing figure of 12,051. If that had been me as a candidate, I'd have forgotten the goodwill. I'm sure I would. So is anyone going to throw their toys out the pram? No. Don't deliberately forget things, but the odd mistake, no one minds. So the additions, 12,051, and this does matter. If you come back up here, purchase of intangibles, 12,051. What matters is that for outflows you show brackets. Now, you will lose marks if you could consistently get the bracket convention wrong. It doesn't matter so much in the soft P. It doesn't matter so much in the P&L. It's very, very important here in the cash flow. So it's an outflow of cash. I'm looking back at the scenario now, and the next line is about PPE. You probably wonder why I keep turning my head like this. It's because I've got another screen with the scenario, so it's not because I've got a sore head. On PPE, we're told that there were some additions. No, the only additions were what came with flour. We were told about there were some disposals, and we're told about depreciation. So again, That needs sorting out, doesn't it? Ideally, by the way, you cross-reference to workings. Again, they're not going to deliberately ignore your answer if you haven't always cross-referenced. It's nice to if you remember, but W1 is a good cross-reference for that first one. Working 2, by the way, you can do T accounts if you prefer. I think it's quite hard to sort those out using the technology, and particularly in Excel or anything, so I tend to use schedules. I'm reconciling the opening and closing PPE. Again, if you're rusty on these, it's very important you go back to our financial reporting materials and practice cash flows. They're coming up, but the basic reconciliation type stuff is presumed knowledge. So I'm picking up the opening and closing assets. So that was 52,818, 55,124. The subsidiary acquired brought with it PPE. Now be careful, in the list of assets there was 18,076, but you've also got the fair value adjustment, which was 600. So I think in total that's 18,676. You've also got the depreciation, which was given as 10 million. So the balancing figure that drops out is the disposal. And remember, that's the carrying amount, the net book value of the disposal. So again, the net book value of the disposal is 6,370. That's not the proceeds. And what we need to do, of course, is say, was it sold at a profit or a loss? It says in the scenario it was sold at a loss of 2 million. Therefore, the proceeds are going to be 2 million less than that. So here I am with the proceeds up here. There we go. Sale of PPE. We've got 6,370 minus 2,000. That would give me a net inflow of 4,370. 4,370. We're doing well. The next paragraph in the notes says we bought butter. That's a separate associate, isn't it? 5 million cash. That's the second associate they mention. Very easy, that one then, isn't it? Purchase of associate. This was butter, 5 million. I'll just put butter there. That's not the associate that became a subsidiary. It's a different associate. It does say we got dividends from associates. So let's have a look at those now. And we'll do that in working 3. Which again, I think, is a little bit tricky. But if you've had some practice, again, it's all right. Remember, a lot of these adjustments repeat themselves from exam to exam. So we're reconciling the brought down and the carried down. List of carrying amounts on the second page of the question for the associate. Brought down 23194. Carried down 26328. In terms of what we've got the new associate, which was butter. The cost of that was 5,000. We also said goodbye to the old associate, which was Flower, which became a subsidiary. In the same way as a caterpillar becomes a butterfly. So we got rid of the old associate, which is a disposal. It would have come out of the carrying amount of the associate. What was its carrying amount on the day we worked out the profit on sale? I'm looking back right to this very start of my workings. I'm just going to highlight it. In fact, I'll highlight it in green. There it is. It's this one here. That's the 14.8. That is, again, the figure to which we said bye-bye. It came out of the associate when the associate was replaced by a subsidiary. So the old associate has gone away. That's 14,800. Hard to spot. Easier to spot, though, are things like the share of post-acquisition profits. The share of post-acquisition profits, again, was given in the data on the second page, and that was 15,187. I think we've got everything, 28,420. Yeah, so the final figure drops out. That's the dividend, again, that was paid out by the associate, drops out as a balancing figure, reducing the carrying amount, 2253. Be careful, attention, attention, that's an inflow of cash. So back over here, I've got an inflow of cash, there it is, the dividend from the associate, 2253. There was no purchase of PPE, was there? I'll just get rid of that for now. Good. Then you get to the next paragraph, which goes on and on and on about investments through fair value, through profit and loss. There were disposals, they were sold at a profit. You read that big paragraph and then you say, I've got a headache. Remember, this is the point when, if you're the prize winner, you'll have cracked this before I mention it. If you're an ordinary person like me, you'll have a headache. Do you turn left or right? If you turn left, you spend half an hour working it out, get it wrong and get nothing. If you turn right, which is the way I'm going, you follow my motto, if in doubt, cross it out. So personally, I would never ever have attempted that. There are so many easier marks later on. You can just see by the length of the paragraph, it's just not worth it. Life is too short. So I won't be talking about it in this debrief. Those of you that are the prize winner, obviously you can check back and just see if you got it right. The rest of you could have a quick look, but go for the easy marks. Very easy mark now is the bottom paragraph on the first page, and that is about the issue of shares. So we're going to call that working for reconciling share capital and share premium. That's a much easier thing. You know, life, just keep it simple. So we're looking at share capital and share premium. Always reconcile them together. Don't try and split them out. Brought down from the data in the question. The brought down share capital and share premium 20,000 and 18,000. 38. You see how calm we are? We cross that out and we're carrying on with the exam. Carried down. We've got 23 and 33.6. That's 56.6. The big change in the year, remember, is the sub purchase. When we purchased the sub, we bought some shares. So we'll find those somewhere upstairs, again, in the working. So let's take ourselves back upstairs in just a moment. See if we can find the purchase of shares. The purchase of the sub with shares. It's back in the Goodwill working. I'm just highlighting it in blue. It's that 9 million. So that's the big reason why the shares changed in the year. There we are. That's 9,000. Anything else, of course, would be a share issue for cash. That's the balancing figure. There are my proceeds of issue. And I think that drops out eventually as 9,600. Again, don't spoil the pudding before you've baked it. Remember, the 9,600 is an inflow. So again, we need to show that as an inflow of cash in the cash flow statement. There we go. Inflow of cash in the cash flow statement, if I can find it, is 9,600. Continuing with the scenario, no more notes, but when you look at the remaining data, what you probably see there is NCI. So we certainly need to sort out the dividend to the NCI. There doesn't seem to be any loan. There's no reference to any dividend, so it's just the dividend to the NCI. We'll do that in our last little working, which is working 5. Working 5. Reconciliation of the NCI. Very important working. Brought down. Reconciled to carried down. We're given the opening and closing figures, which were 12,914 and 30,152. We're given the figure from the Splocky, P&L OCI, which was 9,162. Remember that one reason why the NCI is so much bigger is the NCI on the new sub. Again, we can see that if we look back at the Goodwill working. Let's just pick a nice highlighter colour. We'll go for green. Blue, in fact. Looking back at the Goodwill working, let's see what the NCI was on the new sub. There it is, the 11,400. All of these are follow-through marks. So if you got it wrong in the first part, you won't be penalised again. No matter how crazy your answer looks at the end. Balancing figure is then the dividend to the NCI, which 21.32. Yes, that drops out, I think, as, there we go, 312,914, 9162. Yeah, 3,324. Make sure, finally, you show it as an outflow of cash. The dividend to the NCI, outflow of cash, there it is, 3,324. Lovely. And that's the big part of the question finished. If you need to, pause the recording before you look at the last part, which is about the pension scheme and how it's reflected in the cash flow statement. There are a few numbers given, but not many. But it does just say, describe the impact of a pension scheme on a cash flow statement, so where it appears. So if you're not familiar with this, again, this is an answer that perhaps needs learning. In terms of the movements and the things that have happened, there are 2 points that are very important because they're always relevant. The first one is that you add back the service cost in the operating section of the cash flow. That's because the service cost is a number calculated by an actuary. It doesn't actually represent the amount of money that has physically been paid to the pension plan. The second point, which you must know, is that you deduct the contributions paid, again, in the operating section. You take out the service cost and then you deduct the contributions paid. That you must know because it's in every single question. So if you get those 2 marks, face it, you've passed that part of the question. It's all I'm bothered about. In terms of the rest, in terms of ones that will be fairly easy to explain, I'll just pick up a couple of things. The benefits paid, this is the amount, isn't it, that the pension plan pays to the beneficiaries, the pensioners who've retired. That is used, when you do the reconciliation, it affects both the assets and the liabilities of the scheme. It's not money that is paid out by the company. So you can just say the benefits paid, this is a cash flow of the pension plan, which is a separate entity, not. So it will not be in the company. It's a cash flow of the pension plan, not of the company. If I mention one more, that will do. When they talk about the remeasurement difference, well, here's an obvious question. Remeasurement difference is revaluation. Do you put revaluations in cash flows? No. So remeasurement difference will not be in the cash flow. The 2 that you must learn, though, the 2 I'm particularly bothered about, are the first 2. Because you'll see those in every question. And that there ends the debrief of question 1.